Hey, everybody. For those of you who follow the stock market or have been watching any of the financial news today, you will know that the Standard & Poor's 500 index closed below 700 today for the first time since 1996. Now, just in the interest of clarity, I'm talking about the Standard & Poor's. I'm not talking about the Dow Jones. The Dow Jones is actually 30 of the largest industrial companies across the country. Kind of a skewed average, actually. The NASDAQ is predominantly tech-heavy, so that's a little bit skewed as well. The Standard & Poor's 500 is probably the broadest index, includes the 500 largest companies in the country. So today, I thought I'd try and answer the question, is this a good time to buy? Now let's take a look at some of the statistics. And I'm going to start with construction spending. Look at this. Construction spending, if you look at the top graph here, has been nosediving ever since the beginning of 2006. And just to give you some context, here's year 2001, 2002, when this country was supposedly in a recession. The lines don't look anything like they do now. So I think this recession or depression is very different than what we saw 7 years ago. Let's move on to car and truck sales. Look at this graph on the right-hand side. You'll see that the lines are nosediving. And again, for context, here's 2001, 2002. Car and truck sales are interesting because they're essentially a leading indicator. So if sales of trucks go down and cars go down, then the companies making cars and trucks have bad earnings next month and they drop production and lay workers off. And then those laid-off workers spend less, and so that all happens 2 months from now, and it all happened because sales dropped this month. So these lines are going to be affecting us for the next few months. Turns out there's actually leading indicators in all kinds of different areas. And here's a graph. It's a complicated graph, but if you look at the thick red line, that's leading indicators. So that's an indication of where we're going. And again, just by context, here's 2001, 2002. But you'll see that that red line is right down at the bottom of the graph right now. So things don't look so good for the coming months for the economy. All right, moving forward. PE ratios. This is the comparison of price to earnings. When you buy a stock, you're buying the earnings of that company. So the price you pay for that stock can be compared to the earnings of that company as a gauge of how much you're paying or how expensive those earnings are. And again, for context here, here's 2001, 2002. Now, if you look far to the right, you'll see that the red line at the top just jumped up recently. And we all know that's not because stock values have been going up. Rather, they've been going down. But the earnings have just collapsed, which means that the price-earnings ratio, that ratio of the two numbers, shot up very quickly. And if you look at the green line at the bottom, dividends have literally been cut in half during the last 12 months, 18 months. So that doesn't look so great either. All right, moving forward, unemployment. Look at this graph. Here's our comparison, 2001, 2002. Unemployment claims have gone through the roof, higher than anything we've seen really ever. And of course, this leads to consumer confidence. When people get laid off, their confidence goes through the floor, and lo and behold, here it is. The blue line, further down than we have ever seen. Now, this graph covers a lot more years than the previous few, so the 2001, 2002 is pretty close to the right-hand side here. And you can see that where we are right now, the blue line, it's further down than that. It's further down than the 1991 recession, and it's even further down than the 1981 recession, and that was a pretty severe one. All right. So let's look at the actual chart of the Standard & Poor's 500, and this covers about 30 years, this graph. I'm sorry that the years aren't listed at the bottom, but there were other things below this graphic, and I just couldn't fit it all in. But it's pretty interesting what's happened. I'm going to look at this chart from a technical perspective, technical analysis, which is people who look at charts and evaluate the charts based on the charts themselves. And if you look right here, between those two red lines, this is what's called a double top. The stock market crossed there back in the late 90s and hit that top around 2000, came right down to about 800, Standard & Poor's 500, bounced off and went right back up to 1600 in 2007 and came down ever since. And you would think, see, a lot of people watch these lines and they put their buy orders right on that line. So you would expect the buy pressure at that lower red line to be strong enough to stop the downward momentum of the stock market so that the price action bounces off the line and starts going back up. But you'll notice that it didn't. It crossed it and went down below it. And it's interesting because there's actually a second trend line, a much longer term trend line, that actually intersects that lower red line right now. And it's also up around 800. And a lot of people were watching that line and putting their buy orders along that line. So there should have been a lot of buy orders that the selling pressure would have had to have crossed through for the stock market to break below that 800 mark, or about 780 actually. And lo and behold, the sell pressure was strong enough and it broke through. Again, just for context here, here's the 2001-2002 period. Point is, this is very bearish from a technical analysis point of view. So if you take all of this and put it together, is it time to buy? Well, I would say no. At least not yet. It's possible that the market may turn around soon, but until it proves that it's breaking out of the downward pattern, I would not buy anything right now. Okay, couple of acknowledgments. Thank you so much to Martin Capital Advisors. You guys put some spectacular graphs and charts together. They're free of charge on their website. Thank you so much. You made this presentation possible. And thank you to you for watching. If you like this video, please rate it and leave a comment. And if you did like the video, please tell your friends about it. Thanks again for watching. Until next time.